You are listening to ESG News and Views from the Conference Board.
Hello, this is Paul Washington, Executive Director of the Environmental, Social, and Governance Center here at the Conference Board. The ESG Center focuses on helping companies define and fulfill their evolving role in society by providing timely and relevant insights for what's ahead in the areas of corporate governance, sustainability, and citizenship. In today's podcast, we're going to focus on impact investing and what it means for investors, companies, and all of us as members of society and the planet we inhabit. ESG investing, including impact investing, has been around for decades, but it has gained considerable momentum in recent years. In a webcast a few weeks ago, we talked about ESG investing being no longer a niche, but having a transformational impact on capital markets. Today, we're going to go even deeper in a conversation with Hari Balkrishna, Portfolio Manager for T. Rowe Price's Global Impact Equity Strategy. T. Rowe Price is a publicly owned global asset management firm that has a mere modest $1.5 trillion in assets under management. Founded in 1937, on March 17th of this year, T. Rowe announced the launch of its first impact fund. Hari has 15 years of investment experience and has been on T. Rowe Price's Global Growth Equity Strategy since 2015. Prior to joining the firm in 2010, he worked at Goldman Sachs in the Financial Institutions Group of its investment banking division, and he's a real expert in this area. Hari, thank you so much for being with us today.
It's a pleasure to be here, Paul.
So let's start off with a sort of general question to set the stage. A few months ago, there was a headline that appeared that said ESG investing now represents 17.1 trillion, or 1/3 of the 51.4 trillion in total U.S. assets under management, a 42% increase since 2018. But you and I both know that there are varying ways and degrees to which investors take ESG into account. At one end, you have socially responsible investment funds. At the other, you have funds that I might call, ESG light. They look at ESG, but they don't really base their decisions on it to any significant extent. How would you characterize the state of ESG equity investing right now?
So, Paul, I would say, one thing at the outset, I think it's become almost table stakes to integrate ESG into fund managers' investment processes and their philosophies. And as you pointed out, there's a range of different approaches to the way fund managers look at ESG, right? And so on the one hand, some use external data providers. For want of a better word, some pay lip service to it. And some obviously take ESG very seriously. So you've got SRI on one side or impact investing on the other side. I do think for it to make sense medium term, though, fund managers need to truly embed ESG into their thinking. It's not just about ticking a box now. This actually has real financial implications. And the reason I bring that up is I do think companies on the right side of ESG, so whether that's companies through their business models having a positive impact on environment and society, will have more durable and persistent financial and business models over time. You take the example of Next Era Energy, a traditional utility that has made a very successful pivot away from traditional forms of generation towards renewable generation versus, say, some of the more fossil fuel-based companies or the traditional energy companies, which haven't necessarily made that full pivot. And you can kind of see the differing, fortunes in terms of, market cap evolutions of these companies. So a long way of saying this isn't just about effectively integrating ESG. It's integrating ESG because this has real financial implications. So when I think about the state of ESG investing, I kind of look at it and say a lot of people are increasingly seeing this. And the good news here is I think more and more fund managers are embedding ESG more deeply into their thinking and into their processes.
Great. Really helpful perspective. So let me ask you about where T. Rowe Price fits into this. As I mentioned, you recently announced the launch of your Global Impact Equity Fund. Where does that fit in the spectrum here of taking ESG factors into account?
So just to level set, Paul, when we talk about the three types of ESG investing, so ESG integration is viewing ESG very much as a risk and embedding ESG risks into investment thinking. So, for argument's sake, some investors don't invest in tobacco companies because they worry about the terminal value or the health implications of tobacco over time. SRI strategies typically take mainstream strategies and exclude certain controversial areas of the market like weapons, tobacco, for-profit prisons, and so on. Impact investing is really the front end of ESG. So what we're trying to do here with impact investing is view ESG very much as an opportunity and not as a risk. And so what we're trying to do here is look for companies that can deliver positive environmental and social impact and also deliver financial performance versus a widely accepted benchmark. So in T. Rowe Price specifically, in the global impact strategy, what we're focused on is investing across 3 pillars and 8 sub-pillars. And the 3 pillars being climate and resource impact, social equity and quality of life, and sustainable innovation and productivity. So within climate and resource impact, companies that are involved in reducing greenhouse gases, whether that's renewable energy companies like NextEra that I talked about. We also own companies like Train Technologies, which to their HVAC systems reduce greenhouse gas emissions into the atmosphere. Companies improving ecosystems as well as nurturing circular economies. So we own companies like Waste Connections and Trex along those themes as well. Social equity and quality of life encompasses, financial inclusion, whether that's in developed markets or emerging markets, healthcare. So healthcare is a big theme in the Global Impact Fund, as well as companies that improve people's quality of life, whether that's through personal security, mental fitness, physical fitness. And the sustainable innovation pillar is about technology companies which through their business models can solve for a social or environmental problem. So we own some of the semiconductor chip companies in that theme, so ASML and TSMC. The important point about our approach to impact, and this goes back to what we talked about the state of ESG investing. We're very focused on taking ESG very seriously as a firm. So we've been embedding ESG into our thinking for decades through our focus on governance and proxy voting. We've also created a dedicated environmental and social focused responsible investment team that has a proprietary responsible investment indicator model that scores companies across various different ESG factors. And this feeds into all our analysts and portfolio managers' thinking. Specifically for global impact, I work with the 14-strong responsible investment team as well as our 200 fundamental analysts to scour the world across the market cap spectrum for these ideas across those 3 pillars and 8 sub-pillars. And importantly, we're not just focused on just identifying the financial ideas here. We're also focused on measuring the impact from our investment decisions as well. So impact investing for us needs to be material. So it's got to be material to the company's business model. It's got to be measurable, both ex ante and ex post. It's got to be additional, like we need to be making a difference through our investment. And it's also got to be durable over time. So those are the 4 factors that we really look at when assessing companies for impact.
That's really helpful. Let me ask you a question about geographic distribution of the firms you're investing in. The standard view is that Europe is much farther ahead than the US when it comes to sustainability. And I'm just curious, are you seeing that in the composition of your portfolio? Is it more focused on European companies than it is on US-based companies? How does that play out in geographic distribution for you all?
So yeah, that's a really a fair and interesting sort of observation. So what I'd say there is, while Europe is further ahead in terms of companies accepting ESG or integrating ESG, very very actively into their business model and into their business process, and I guess on the consumer side and the government and regulatory side as well, there's more of a push as well towards companies focusing on sustainability. What I will say is the US is very, very quickly catching up. So what's actually interesting is when I look at those companies truly trying to find some of the solutions or the technological solutions to a lot of the sustainability issues by virtue of, the innovation ecosystem that exists in the US, which, I would call, the world's leading ecosystem. I just happen to see a lot more interesting and innovative companies coming out of the US. So while you're absolutely right that Europe is ahead in its thinking on sustainability, I do find an equal number of companies in the US that I can access these investments in. So geographically, the fund is, more or less neutrally weighted in the US versus the benchmark. So not a big push either way. And mildly overweight Europe in preference to Japan But yeah, specifically with relation to the US, there's still plenty of opportunities to find.
No, that's really interesting, and I'm not actually surprised by that because yes, Europe is certainly farther along when it comes to regulation, but that doesn't necessarily mean you're going to be farther along when it comes to innovation.
Yeah, exactly. And what you find is sometimes market forces come into play, right? So when you take a company like Tesla that obviously was born in the US, a big driver of Tesla's financial model and business model in the future has been the fact that obviously they have excellent cars at the cutting edge of sustainability, but consumers and consumer preferences have meaningfully kind of headed in that direction as more and more people want to replace their internal combustion engine cars with battery operated cars. And so yeah, so that's why I think it's the US is very quickly catching up also from a regulatory standpoint. So I think over time
Right.
One wouldn't expect too much of a difference.
Got it. No, helpful. Well, let me just ask a question about your own personal journey here. How did you become involved in this area of impact investing? What brought you into this particular aspect of asset management?
So Paul, what's interesting is so I've by way of personal background, I've lived and worked in 5 continents. So I've got a very very global background, right from my childhood. And right from my childhood, I was a very, very strong believer in, we need to solve for climate change as a society. And this is, well before the winds of change sort of really started hitting us in terms of sustainability becoming a real force in the world today. I've also always had the view that, finance can make a lot of difference in terms of allocating capital to the best use of that capital. And I've always believed that, one of the roles that we play as asset managers is we're very much focused on that capital allocation decision, right? So when we're actually underwriting capital to an equity story, or if you're a private equity manager to a private equity story, a big part of it is you are actually helping that business to innovate, access capital, invest in capital expenditure and that sort of stuff. But what has changed for me, I guess, in the last decade or so is I've increasingly come to the view that finance can play a really big role in solving for E, S, and G issues, right? So when we think about what that means, I mean, if we can, effectively take capital away from the bad actors and channel capital towards the good actors, I think over time that reduces the cost of capital for the good actors, and it, further sort of enhances that innovative ecosystem we talked about earlier in terms of, whether it's a innovative solar tracker company or it's a company that has come up with a novel way of, generating renewable energy. And that's something I think that is something I really passionately believe in. And so my journey really started on this side with ESG integration about 6 years ago. When I started helping to manage the global growth equity strategy of T. Rowe Price, I guess I really passionately believed in integrating ESG into that process. And as kind of time went on, I could see the real sort of moral and financial opportunity here, right? I could really see that those companies that were on the right side of ESG change had better consumer preferences, better regulatory tailwinds, better industrial preferences over time. And I could see those companies, outperforming in front of me, right? And so, when T. Rowe as a firm started talking about taking this even further, I was very passionate and a big believer in the fact that we should launch an impact strategy and really go all out and sort of embrace ESG as an opportunity. So that's long story, but yeah, it's something that I really passionately believe in, and my more than a decade in T. Rowe has meant that one's able to now influence some of that ESG thinking within T. Rowe as well, which hopefully will make a difference over time given the asset base we run.
Right, and actually, in some ways, the journey you've been on and that T. Rowe's on mirrors the journey that a lot of companies have been on in this area, where they initially looked at ESG issues or sustainability as a matter of compliance or meeting basic expectations. Then it turns into, some cost savings and some risk mitigation. And, it's not true for every area for every company, but companies then will sort of seize, these are areas that it's actually an area of opportunity for us that in fact distinguishes us from the competition. So there's kind of this upward slope that companies have been on, and that the investment community is on as well. So let me ask you though. So we had the pandemic, and we have the pandemic, At the outset, we did a little research to ask people what they thought the impact of the pandemic would be on corporations' sustainability efforts. It was really interesting, the division of views. People in the sustainability area generally thought that it was going to increase the emphasis on sustainability. But when you ask people in other areas like general counsels and investment relations people, they thought that, it might shift it a little bit or even delay it. So they were less optimistic, if you will, if that's the right word, about the impact of the pandemic on sustainability. They thought it might hit a bit of a pause button. How has that unfolded from your perspective in the investment community? Has the pandemic and has the new Biden administration actually accelerated the focus on sustainability? Has it shifted the focus maybe a little bit from environmental to social issues? Curious, what's been the impact of these sort of seminal events on the investment community's views of ESG?
So, I'll say, Paul, and maybe I'm a little biased here, given the seat that I sit on, but I totally and categorically believe that, not just the pandemic, but right from the financial crisis. I think that was really the sort of genesis of some of this stuff, right? The financial crisis exposed the fragilities in the world, order in terms of, a massive increase in inequality across the board, income inequality as well as asset inequality within and across countries. And I think, for a long time, we've always had scientists talk about climate change, and we've always had, plenty of science from very reputable scientists talk about it. But the pandemic, in some ways, the COVID-19 pandemic, in some ways, has exposed a lot of those studies, right? And people have kind of realized that, part of what's happening with, virus mutations and, a lot of that, in some ways itself, goes back to, deforestation. A lot of it goes back to what, humans have done, to climate change in a lot of ways. And so, in some ways, I think it's refocused consumers and the government in that direction. So let me give you a couple of examples of that, right? So when you think about the EU Green Deal, right? So Europe is basically spending its way out of the pandemic, but a big part of the spending is going towards green infrastructure, renewable energy, building insulation, right? And smarter ways of actually, creating mobility solutions. Ditto, with the Biden administration, right? When you look at, and obviously I know it's got to, pass through Congress and things like that, but if you certainly look at the proposals, a lot of the proposals are very heavily skewed towards, providing tax incentives, for greater investment in renewable energy, greater uptake of electric cars, more, charging points and that sort of stuff. So I'd actually say the pandemic in some ways has afforded a lot of governments the opportunity to use fiscal policy to really drive the sustainability agenda even further. It was also pleasing to see China now have a net zero target finally. So China being, unfortunately the biggest, emitter of pollutants today, basically more than the US and all the developed world combined.
The developed world, right?
Exactly. So it kind of really matters what China does too. And so it's great to see China also come up with a net zero target, as we've kind of lived through the pandemic. So that's the environmental side. And I'd say on the social side, the pandemic, obviously has had a horrifying impact on employment. But while it doesn't show up in the unemployment figures, right, it's had a horrifying impact in terms of pushing more and more people in temp work and, really kind of exaggerating the gig economy, right? And so things like workers' rights, things like ensuring that people, earn a fair wage, earn some fair benefits, and have, rights that a lot of people in the world enjoy, I think has become, even more front and center. So I'd say in certainly in investors' eyes, the pandemic, the new administration, a lot of what we're hearing out of China, the upcoming, climate conference in Glasgow, the COP26, I think a lot of these kind of put together have really, I would say, accelerated investors' thinking on sustainability. And I'd say I see it across all the companies I've talked to. Everyone's either interested in, accelerating that agenda, or some companies that haven't made that change, they want to hear about how they can make that change. And so that's definitely something that is pleasing to see, that it's accelerated.
So Hari, let me ask you a question a little bit from a maybe slightly more skeptical standpoint. The world is a washing capital these days. And I'm just wondering if you talk about the extent to which sustainability makes a difference for established companies in accessing capital from equity markets, and whether it's different for a company doing an IPO? Obviously, if a company has a bad record or looks bad in these areas, they may be excluded from your fund or from an SRI fund. But in this world that's sort of awash in cash, what difference does sustainability really mean in a company's access and cost of capital, if you're an established company or if you're doing an IPO?
So ultimately, companies that are on the right side of change from a sustainability perspective, I believe, will have more durable, persistent business models and will enjoy better, earnings growth, better cash flow growth, and a better return profile. So when I think about why sustainability makes a difference, I think that's how it makes a difference for these companies. So I think it's got real financial implications. And Paul, to your point about the market being awash with cash, I mean, those cycles go up and down, right? I mean, so, obviously we had a massive drop in interest rates and a massive, rise in sort of liquidity because of the pandemic. But you could quite easily see a scenario sort of, 3 to 5 years from now where quite the reverse happens, where liquidity tightens as the economy recovers. And in those scenarios, I think it's really important for companies, whether it's established or, coming out for IPO, to have sustainability front and center in their business models, because I think ultimately that will have a real impact on their cost of capital. And that's why when, if I were to just make one final point on this, some investors would push back on stocks that have, for want of a better word, an ESG halo, and would say, oh, these are really expensive stocks, and, it doesn't make sense, for what growth those companies deliver. And I always kind of push back and say, well, those companies probably will deliver that growth for a much longer period of time, because those business models are skewed and shaped in the right direction towards where consumers want those products, or industrials want those products, or governments want those products to be going.
So Hari, another challenge companies have is the struggling with the information they need to provide to the market. They fully understand that investors need hard data, reliable data, consistent data across an industry, and often across all industries, to make their investment decisions. But there are so many rating agencies, there's so many reporting frameworks. Frankly, there's so many different approaches to assessing materiality that are out there. What's your advice for companies on the kind of information they should focus on providing investors to really help you make your decisions?
It's a great question, Paul. And unfortunately, it's one of the realities of the industry, both on the investment side as well as among the established companies, where, as you say, there's so many different reporting frameworks, and measurement is something where, as an industry, we haven't necessarily come up with a sort of common language or an impact measurement, right? So if I were to give you T. Rowe Price's own example, what we're doing is we are at a single stock level trying to measure the impact by a lot of these companies, right? So when you think about, let's say, HDFC Bank, which is a private Indian bank that we own in the portfolio, which has a very meaningful semi-urban and rural microfinance and financial inclusion story attached to it. We are basically trying to measure what the impact of financial inclusion is on a stock-by-stock level for HDFC Bank. But it's very difficult to do that across the whole portfolio, sort of have a common language, right? So again, for the next year example, we have to measure them using the amount of renewable energy generation, or for that Trex example or Waste Connections example I gave you earlier, we have to look at, what is the impact on methane capture, or, plastics being taken out of the landfill, for example. So what I always, tell companies is, firstly, the more the disclosure, the better. Now, obviously, this shouldn't be a greenwashed disclosure, so it should be an honest disclosure. And I think this is where there are some pretty standard frameworks like SASB and TCFD out there that I always encourage companies to sign up to or use. And what I always encourage companies to do is ideally report on their own footprint. So a lot of companies do that relatively well, particularly in the developed world. But very few companies do a good job of reporting what their external impact is in terms of their business model, right? So from a social or an environmental perspective. And I always encourage companies, for example, to report on their Scope 3 emissions, where they can track it all, come up with a best guess estimate there from a carbon standpoint. So, yeah, so, long way of saying, I'd say, obvious standards like SASB, TCFD out there, and not just the company's own footprint, but also the external impact as well. Because in the global impact strategy, what we're most focused on is the company's external impact. So if it's a healthcare company, for example, we're more interested in how many lives the healthcare company saves or how many quality of lives the healthcare company improves, as opposed to, the healthcare company's own, carbon emissions, for example.
So you mentioned greenwashing and, where companies tell a story that may not be entirely true, that may overstate things, that may put a little extra lipstick on the pig. What do you look for as an investor to see if a company is greenwashing?
It's something that, I've definitely got my antennas up, well and truly high, Paul, when I'm looking at companies. And I always would say, if I were to give companies any advice, it would be that it's really important to not do that, because a lot of people pick it up pretty quickly and pretty easily. So if you've got a company with, a lot of dirty operations, but, suddenly see a lot of pretty slides or a website that has sustainability in every sort of third or fourth word, I guess I'd just say that investors can, pretty quickly suss that out. So I'd say it's really important that we don't have that, because ultimately I think it doesn't actually do anyone any good. Equally, as investors, and this is something that I tell my clients, right, is as an asset manager, conducting an impact investment, we will make mistakes too, right? So we will invest in something thinking it's an impact stock, and there will be sometimes question marks about that stock that comes up later on that we hear about later or we assess later. And in those cases, I think it's really important, as asset managers and as stewards of capital, to be open and honest with our clients and say, look, we thought this was an impact stock. It turned out that, there were all these things that went wrong with the impact thesis. And so, we had to move on from the stock and, we made a mistake. So equally, I'd say companies should do that too, right? So companies where there is, a meaningful carbon footprint, or companies where there are certain aspects of their business, let's say, they're not sort of naturals, or they kind of have, harmful chemicals or whatever the case may be. I think it's really good for those companies to come clean and talk about the bad and talk about the good, right? So I think if you balance it out, people, have a more credible view of those companies. The signs I typically look for, like I said earlier, one of them is obviously, dirty operations, but very pretty slides and pretty website focused on sustainability. Some of the other, slides, so some of the other signs that I'd look for would be, when there is, let's say sort of an overemphasis on one division within a company that is clean, and then no emphasis at all on the rest of the divisions, right? So some consumer companies, without taking names, will sort of focus very much on their sort of organic offerings or their natural offerings, which might be like 2% of the business, and 98% won't be, right? And so it's those sort of signs that I try and look for when detecting, greenwashing. It is unfortunately becoming pretty rife in the industry. And it's something that, we as a firm are very, very focused on ensuring that when we analyze companies, we can sort of find that out. And equally and importantly, inward looking, as T. Rowe Price, we're very focused on ensuring that we're not, we want to make sure that we're not investing in greenwash investments in the impact fund. And we want to sort of hand on heart make impact investments that are beyond reproach.
Right. That's really helpful. Thanks for, especially in those signs. And I've seen that too with companies that focus on one product line or one business unit. I would say though that we recently put out a paper that talked about the gap between ESG performance and disclosure. It was interesting that actually U.S. companies in general are performing better than their disclosures indicate. Now it was based on some data from a few years ago, but it did suggest that at least U.S. companies have an opportunity to avoid greenwashing as they up their disclosure story, sometimes to match their performance, which just right now isn't even being captured in their disclosure. Let me ask two final questions. Just very broadly speaking, what do you think is the main area of ESG opportunity, generally for the industry as you look out 5 to 10 years? What are the areas that you think the real opportunities for growth for companies?
I mean, so when I look at opportunities here, Paul, I mean, two areas of the market that I would really call out that I'm very excited about. So one is climate technology in general. So that obviously covers off traditional renewable energy generation companies, but it also covers companies that are involved in the green hydrogen ecosystem, companies focused on, fission, generation that can completely take carbon emissions out of the equation, A lot of companies involved in circular economy type activities. So whether that's companies taking plastics out of landfill and recycling them, or companies involved in things like bioplastics, biopolymers, all areas that I'm really excited about. And then the other area would be healthcare. More generally, I think the amount of innovation that's actually happening in the healthcare space. When we kind of move from genetic science to say things like proteomics, I'm really excited about value-based care. I'm really excited about individual gene-based therapy. And I think over time, when we look over the next sort of 10, 20, 30 years, I think there's going to be a lot of improvement to people's quality of lives from a healthcare perspective. So really excited about the opportunities I see there. Yeah, I mean, in terms of risks, I mean, the big risks I would still say are those companies that have some of these more traditional business models that, for want of a better word, aren't good climate actors. And I think the ones that embrace the change better will survive and thrive, and the ones that don't, I think, run the risk of oblivion over time.
Right. So, final question: you're in an elevator with a CEO of a company who's leading a firm that is aware that ESG is important to investors, but really doesn't know how to get started in a way that's going to be meaningful for her or his company. What advice would you give to that CEO who knows this is important but isn't quite sure how to go ahead?
So, given I'm in an elevator, I'll have to be quick. So, what I'd start with is I'll say live and breathe ESG, and the best way you can actually start cascading ESG through a company and an organization is create the incentives in place, whether it's the top 100 managers of the company or the top 200 managers of the company. Introduce ESG into the balance scorecards, introduce ESG into the performance reviews, and trust me, the minute that is done as a first step, it automatically creates this really virtuous loop of idea generation within companies, and it really forces a lot of companies to veer in the sort of direction towards integrating ESG into their thinking, into their products. And I've seen this time and time again. The minute companies change their incentive structure for their top managers and embed ESG into that, there are some really meaningful changes that actually happen for the better. So that's the first and the main thing I would do. And the second thing I would do is, work pretty hard. Given that this is a company starting out on its ESG journey, there's a lot of consultants out there who can help companies with commencing their ESG journey, whether it's on the product side, the strategy side, or working with investors on the ESG stories. So those would be the two immediate steps I'd take. This should have been maybe a 30-floor journey on the elevator now. So.
Right. Well, hopefully you'll have a chance to ride down with the CEO as well. But look, that's enormously helpful. I can't thank you enough, Hari. This has been a terrific conversation. You've provided a lot of excellent advice and insights for our listeners. And I want to thank everyone for listening to today's podcast. A link to T. Rowe's white paper on impact investing is available on this podcast's webpage. And you can find additional podcast webcasts on all things corporate governance, sustainability, and corporate citizenship by visiting ESG News and Views at conference-board.org. So thank you again for listening, and thank you, Hari, for a terrific conversation and for all your work in this area.
It's a real pleasure to be here, and thank you for listening.
This has been ESG News and Views from the Conference Board.